Moody's downgraded the U.S. credit rating last week, citing growing budget deficit and interest expenses. Japanese long-term bond yields hit a record high this week following a poor bond auction. Sovereign bond issuance in OECD countries is projected to reach a record $17 trillion this year, up from $14 trillion in 2024. Is there a global bond crisis in the making? And what does it mean for your money? With the Moody's downgrade, the U.S. lost its last AAA rating. One might have thought this was a big deal. U.S. bonds, U.S. stocks, and the U.S. dollar all fell when markets reopened following the downgrade. However, it took little time before they recovered. By the end of the same day, it was as though nothing had happened. Why? The reason is that the downgrade carried little new information. Indeed, it has been a long time since the market stopped treating the U.S. as a AAA credit. With the U.S. 5-year credit default swaps trading in the mid-50s right now, they're no higher than those of China and Italy that have much lower credit ratings. China has a Moody's credit rating of A1. That is 4 notches below that of the U.S. AA1. Italy has a Moody's rating of Baa3, which is 8 notches below that of the U.S. Yet the CDS of the U.S., China, and Italy are all trading at similar levels. So what is going on? Credit default swaps are an insurance against defaults. Default risk is foremost a function of how much debt you have. The stock of general government debt as a share of GDP of the United States and Italy are similar at about 130%. China's stock of general government debt as a share of GDP is lower than both that of the US and Italy. However, this is only because the Chinese general government debt statistics do not include China's massive shadow debt. If we look at total debt, China, US, and Italy have actually very similar debt levels, around 300% of GDP. This makes these 3 countries among the most indebted countries in the world, ranking in 4th, 5th, and 7th place among G20 countries, respectively, according to IMF calculations. But default risk is not only a function of how much debt you have, but your ability to keep rolling the debt and finding more buyers for new debt. The fact that both Italy and China run a current account surplus means that they're less dependent on fickle foreigners to finance their debt. In contrast, the U.S. runs a large current account deficit. What can we infer from the fact that the U.S. credit default swaps are trading at similar levels to those of China and Italy, despite the U.S. running current account deficit and the other 2 countries running current account surplus? Why isn't the U.S. paying more as a current account deficit country? Might it have something to do with the fact that the dollar is the world's reserve currency? Interest rates are a function of many variables, like inflation expectations and growth potential. This makes it difficult to prove that the dollar's reserve currency status lowers the cost of borrowing of the US. But comparing the US with China and Italy, 2 countries with similar total debt levels and similar default risk premium to those of the US, we might infer that the bond market attaches the same value to the dollar's reserve currency status as to a small current account surplus. I don't know what that translates into in terms of savings for the US, but I'm pretty sure it is a big number. I suspect Scott Bessent would agree. I suspect this is why he keeps insisting that a weak dollar is not part of the trade negotiations. Indeed, earlier this week, he went out of his way to say that he did not discuss the dollar-yen exchange rate when he met with the Japanese finance minister. Trump's tariffs have already pushed up the US borrowing cost. The 30-year mortgage rates are back to 7%. Driving down the dollar will send the US borrowing costs even higher, at a time when interest payments already account for 1 out of every $8 spent by the US government. Bessent, if not Trump, understands that the US cannot have the cake and eat it too. This is why I don't subscribe to the view in the market that the US is actively pushing for a weaker dollar. It is either tariffs or a weaker dollar, and it's very clear that Trump has opted the former. And importantly, right now it looks like tariffs are here to stay. This does not make me a dollar bull, but it does make me think that the case for selling the dollar right here, right now, is not quite as straightforward and compelling as some people think. Tariffs are inflationary for the US and deflationary for the rest of the world. This means the interest rate differential between the US and the rest of the world will widen as the tariff war plays out. An ECB official suggested this week that the ECB may have to cut interest rates below the neutral rate to prevent inflation from falling below its target. The same is true for China. The trade war with the US is strengthening the deflationary forces. In April, China's producer price index dropped 2.7%, and the consumer price index fell 0.1%. This week, the People's Bank of China cut the one-year prime rate to 3% from 3.1%. Both the ECB and the PBOC have room to keep cutting interest rates. The market thinks that the terminal rate for the current ECB easing cycle will be 1.6%, but there's no reason to think that 1.6% is the floor. The ECB kept its policy interest rates in negative territory between 2014 and 2022, in large part to discourage an appreciation of the euro against the dollar. Moreover, negative interest rates are no longer a taboo as they once were. I can see how the interest rate differential argument might turn against the dollar later this year, but it seems to me we're not quite there yet. Japan, of course, is a very different story. This is because inflation in Japan is still running hot. CPI inflation came in at 3.6% last month. High inflation is weighing on household confidence and the approval rating of Prime Minister Ishiba's cabinet that fell to 20% just 2 months before the crucial upper house elections. The Bank of Japan is tapering its purchases of government bonds. Despite the gentle pace of the tapering, long-term Japanese bond yields have been spiking lately. Increasing Japanese bond yields are likely to sap the appetite of Japanese investors for foreign bonds further. China has been reducing its holdings of US Treasuries. I have to believe that after the massive appreciation of the Taiwan dollar over the past month, Taiwanese life insurance companies will be slowing their purchases of US government bonds. I don't think Japan will be cutting its holdings of Treasuries, but its capacity to buy more will be more limited going forward. A weaker yen has done very little good for Japanese exports. Japan might now have to try a stronger yen to keep the borrowing costs of its massive debt under control. I've been running a long position in 5-year notes for a while, on the view that the Federal Reserve will cut rates more aggressively than expected. The position has been bleeding for the past 3 weeks, as the market reduces the expectation of Fed rate cuts this year to just 2. I didn't expect the extent of the recovery of the US stock market. The result of the massive equity rally has been a significant easing of financial conditions that has persuaded the market that the Fed won't have to come to the economy's rescue after all. My only comfort is that the surge in bond yields has made stocks even more expensive. With the stock market not far from its all-time high, tariffs-related price increases on their way, and the end of Trump's 90-day pause announced on April 9th fast approaching, I'm not yet ready to throw in the towel on my 5-year note position. I don't believe we can get a stock market bubble and a bond market crisis at the same time. Something has to give. My bet is that the stock market will have to give ground to avert a bond market crisis. The only question is how soon. Thank you for listening.